Ladies and gentlemen, today we stand at a crossroads in the world of finance, a moment that will define the future of markets, wealth, and freedom. What I'm about to share is not just about silver, it's about control, power, and the forces shaping our economic destiny. They control the kill switch. Yes, the very mechanism that can stop the flow of free market trading in its tracks. And if we don't understand it, if we don't act, we risk losing the very freedoms that have built prosperity for generations. The very idea that a single entity or a small group could control the trajectory of an entire market sounds like the stuff of conspiracy theories, but in today's silver market, it is a reality we can no longer ignore. The so-called kill switch is more than just a metaphor. It is a tangible mechanism that can halt trading, freeze liquidity, and manipulate prices at a scale that directly impacts investors, businesses, and entire economies. Imagine sitting at your trading desk, making carefully calculated decisions based on supply, demand, and historical trends, only to find that your playing field is suddenly frozen, dictated not by economic principles but by the will of a few. This is not theory, this is the modern landscape of silver trading, and the stakes are higher than ever. The market, in its ideal form, is supposed to be a level playing field. Prices are meant to reflect the collective decisions of millions of participants, from small investors to multinational corporations, each responding to real supply and demand. But when control is centralized, the price no longer reflects these fundamentals. Every fluctuation, every spike or drop is subject to intervention. Those who hold the kill switch can effectively pause the market, suppress volatility, or even orchestrate sudden shifts that serve their interests rather than the broader economic reality. This is not merely an inconvenience. It fundamentally undermines the very principles upon which markets are built. Consider the implications for businesses that rely on silver, whether for manufacturing, technology, or investment portfolios. Decisions about inventory, production, and long-term strategy are based on the assumption that market prices are genuine reflections of scarcity and demand. When manipulation occurs, these assumptions crumble. Companies may overpay for raw materials, underprice their products, or miscalculate risk. The ripple effects extend far beyond traders. They reach factories, employees, and ultimately consumers, showing how a single point of control can disrupt the entire economic ecosystem. Investors, too, face profound consequences. Markets are inherently risky, but the risk is supposed to be transparent and manageable. When a kill switch exists, the risk becomes opaque and uncontrollable. Traditional models of diversification and hedging are rendered less effective because the market can be frozen or redirected without warning. Small and medium-sized investors are particularly vulnerable, as they often lack the resources, intelligence, or access to anticipate these interventions. Meanwhile, those behind the switch can exploit this knowledge asymmetry to their advantage, consolidating wealth and influence at an unprecedented pace. What makes this situation even more dangerous is the subtlety of control. Intervention does not always manifest as dramatic spikes or crashes. Sometimes it appears as slight delays, muted movements, or suppressed volatility. These small manipulations can accumulate, eroding trust in the market over time and slowly conditioning participants to accept a controlled system as normal. This is where vigilance becomes essential. Recognizing patterns, questioning anomalies, and staying informed are no longer optional. They are survival skills in an environment where the rules can be rewritten at a moment's notice. The hooks are everywhere if you know where to look. Ask yourself, if a single decision can stop the market, who benefits and who loses? How can millions of participants make rational economic choices when the foundation of the market itself is uncertain? Every informed investor must confront this reality because ignoring it is not a strategy, it is a guarantee of disadvantage. Knowledge, strategy, and foresight become the only weapons in a system where the market's natural mechanisms are no longer entirely in the hands of the people. In this era of centralized control, understanding the mechanics of the kill switch is not just about protecting wealth. It is about preserving the integrity of decision-making. Every investor, trader, and business leader must ask hard questions, remain alert to manipulation, and seek opportunities in transparency gaps. Because in a market where a few hold all the cards, the edge lies with those who see the game clearly, act decisively, and refuse to be passive spectators. Every market relies on price signals to communicate critical information, signals that tell producers how much to supply, investors how to allocate resources, and consumers how to spend. Prices are more than numbers. They are the language of the market, translating scarcity, demand, and sentiment into actionable decisions. But when intervention enters the picture, when the kill switch is triggered, these signals are no longer reliable. Imagine navigating a complex map where landmarks suddenly disappear, paths change without notice, and the compass spins erratically. That is what market participants face when price signals are distorted, delayed, or manipulated. The very framework that guides rational economic decision making begins to crumble. Price signals serve as the invisible hand of the market, coordinating billions of individual decisions into an efficient allocation of resources. When the market is free, a rise in demand pushes prices up, prompting producers to increase supply and signaling investors that opportunities exist. Conversely, falling prices indicate oversupply or waning demand, prompting adjustments across the system. This feedback loop is the lifeblood of market efficiency. Interference, however, distorts this feedback, creating illusions of scarcity or abundance that mislead participants. What looks like an opportunity may be a trap, what appears as stability may conceal volatility, and every misread signal can translate into real financial loss. Businesses feel the impact immediately. Manufacturers relying on silver for production may overestimate demand, purchasing excessive quantities at inflated prices, or underinvest when manipulated prices suggest low scarcity. Investment strategies, inventory planning, and long-term contracts all hinge on accurate price information. When signals are corrupted, companies make decisions based not on reality, but on controlled narratives. The consequences cascade: overproduction leads to waste, underproduction leads to shortages, and consumers ultimately pay the price. The economy begins to operate not on fundamentals, but on a distorted perception shaped by the actions of those who control the kill switch. Investors, too, confront an invisible adversary. The market, once a place to apply skill, analysis, and intuition, becomes a game where unseen forces determine outcomes. Traditional tools for predicting trends, historical data, supply-demand models, technical analysis, lose their reliability when price signals are manipulated. An investor might buy silver expecting a natural market reaction, only to witness an abrupt freeze or sudden reversal dictated by artificial intervention. The frustration is compounded by the subtlety of control. Not every manipulation is obvious. Sometimes prices are nudged incrementally, conditioning participants to trust numbers that no longer reflect market reality. The stakes are high, and the hooks are impossible to ignore. Ask yourself, if the very prices we rely on to make decisions are compromised, how can we navigate the market with confidence? How can businesses plan, investors strategize, and economies function when the most fundamental communication tool, the price signal, is distorted? These are not abstract questions. They define who wins and who loses in a market where perception can be controlled and reality can be rewritten. The power lies with those who can anticipate manipulation, interpret subtle distortions, and act decisively while others remain reactive. Understanding the importance of accurate price signals is not just about economics, it is about survival in a system where knowledge is power. Every fluctuation, every trend, every anomaly must be scrutinized with a critical eye, because the kill switch doesn't just freeze the market, it freezes opportunity for those who fail to see beyond the surface. Awareness transforms uncertainty into strategy, and strategy transforms risk into potential. In a market where the rules can be bent or broken at a moment's notice, mastering the language of price, reading between the lines, and staying ahead of manipulation is the only way to maintain control over outcomes. Wealth concentration is one of the most powerful forces shaping modern markets, and in the context of silver trading, its effects are becoming impossible to ignore. When a few players gain control over critical market mechanisms like the kill switch, they do more than influence prices. They consolidate power in a way that reshapes economic opportunity for everyone else. Imagine a game where the rules are written by the few who hold the resources, and every move you make as an investor or business participant is influenced by decisions made behind closed doors. This is the reality when wealth and influence are concentrated, and the implications extend far beyond trading floors. They touch livelihoods, innovation, and the very structure of economic freedom. Concentration of wealth amplifies the ability to manipulate markets. Those with vast resources can absorb volatility, strategically execute trades that smaller participants cannot, and, crucially, exploit mechanisms like the kill switch to control outcomes. For the average investor or smaller business, the market becomes a battlefield where they are at a structural disadvantage. Every movement in price, every shift in supply, every signal of opportunity can be influenced not by market fundamentals, but by the calculated strategies of a few powerful entities. This is not simply a theoretical risk. It is an observable trend in modern silver markets, where transparency is limited and influence often supersedes fairness. The implications for economic inequality are staggering. When wealth is concentrated, the rewards of market movements disproportionately accrue to those already in control. Profits that might have been distributed across a wide base of participants are instead captured by a small elite, reinforcing a cycle of advantage that is difficult to break. For smaller investors, the stakes are higher, risks are amplified, and the pathways to financial security are narrowed. This concentration is not just about money, it is about control over economic destiny. Those with wealth have the ability to influence decisions that affect millions, shaping markets in ways that can lock out competition and restrict upward mobility. Consider the psychological and strategic effects on market participants. When the market is perceived as controlled by the powerful, confidence diminishes. Investors hesitate to make decisions, businesses delay or scale back plans, and innovation can stall. The kill switch is not merely a technical tool. It is a symbol of control, a demonstration of power that sends a signal to the market: the few dictate terms, and the many must adapt. This creates a chilling effect, where participants react defensively rather than strategically, often missing opportunities because they are waiting for permission from forces beyond their control. The hooks in this scenario are clear: who benefits from these interventions and who bears the cost. Every dollar shifted by market manipulation is not neutral. It is a transfer of power and opportunity from the many to the few. Awareness becomes the first step toward empowerment. By understanding the mechanisms behind wealth concentration and market control, investors and businesses can develop strategies to mitigate disadvantage, seek alternative opportunities, and remain agile in a system tilted against them. Knowledge of concentration is not just information, it is a competitive advantage. The concentration of wealth also has systemic implications. As power accumulates in the hands of a few, the market becomes more fragile, more susceptible to shocks, and less reflective of true economic conditions. Price movements may no longer indicate genuine scarcity or abundance, but instead reflect strategic actions of dominant players. Recognizing these patterns is critical. For those who study, anticipate, and act with insight, what appears as a threat can be transformed into an opportunity. The challenge lies in vigilance, the commitment to education, and the willingness to make informed decisions when others are caught in the inertia of a system designed to favor the powerful. Investor uncertainty is one of the most potent and destabilizing forces in any market, and in the context of silver trading, it has reached unprecedented levels. When mechanisms like the kill switch exist, the very foundation of confidence that markets rely upon begins to crumble. Investors operate on information analysis and the predictability of economic forces, but when control is centralized and transparency is compromised, that foundation erodes. Imagine trying to navigate a storm without a compass, with waves that shift unpredictably and currents dictated not by nature, but by hidden hands. This is the reality that investors face when uncertainty is manufactured and markets are manipulated for strategic gain. At its core, uncertainty alters behavior. Investors naturally respond to risk, but the type of risk they face in a manipulated market is not measurable in conventional terms. It is a shadow risk, a combination of volatility and opacity that defies traditional models. Historical data becomes less reliable, trends are distorted, and even the most seasoned analysts find themselves questioning assumptions that once guided their decisions. When the kill switch can pause trading or redirect market flows at any moment, the rules of engagement change overnight. What once was a rational strategy may suddenly result in loss, and what seemed like a safe position can become perilously exposed. The consequences ripple far beyond individual portfolios. Institutional investors who manage billions in assets are forced to recalibrate strategies constantly, while smaller investors are left in a state of confusion, reacting defensively rather than strategically. Fear becomes a dominant factor, and hesitation can be just as damaging as miscalculation. Every pause, every unexpected shift in silver prices serves as a reminder that control is not collective, but concentrated, and that the outcome of market activity is no longer fully in the hands of participants. This imbalance shifts the dynamics from opportunity, seeking to risk aversion, slowing market activity, and reducing overall efficiency. The hooks in this reality are impossible to ignore. Ask yourself, if the market can be paused at the whim of a few, how do you plan for your financial future? How do you make investment decisions when even the signals you trust may be manipulated? The very uncertainty itself becomes a tool in the hands of those who understand and exploit it. They benefit from volatility, they can orchestrate, and losses they can predict, while the unprepared are left scrambling to react. Recognizing the patterns, reading between the lines, and anticipating interventions are no longer optional. They are essential for anyone seeking to protect capital and identify genuine opportunities. Uncertainty also has psychological implications that are often underestimated. Market participants begin to doubt their own judgment, relying more on speculation, hearsay, or reactive measures. Confidence erodes and hesitation magnifies risk, creating a feedback loop that benefits those who hold power over the market. Yet within this challenge lies an opportunity. Those who remain vigilant, disciplined, and informed can navigate uncertainty with an advantage. In a market where fear paralyzes many, calculated courage becomes a differentiator. Knowledge, preparation, and strategic foresight allow some to thrive where others falter. Investor uncertainty is not a mere side effect of market dynamics. It is a symptom of control, manipulation, and structural imbalance. Every shift in silver prices under these conditions carries lessons for those willing to observe. By studying patterns, understanding the mechanisms behind market intervention, and maintaining a disciplined approach, investors can transform uncertainty from a threat into a tool for strategic decision-making. In a system where volatility and doubt dominate, the edge lies with those who act decisively, informed by awareness and insight rather than by reaction alone. In every challenge lies opportunity, and nowhere is this more evident than in the current state of the silver market. While the existence of the kill switch and centralized control may appear as threats, they also create openings for those who are vigilant, informed, and prepared. Strategic opportunity is born when one understands the rules of the game, anticipates interventions, and positions oneself to act decisively while others are hesitant or reactive. The market is not frozen. It is simply a field where knowledge and foresight have become more valuable than ever. Those who recognize this shift can gain advantages that were previously unimaginable, turning uncertainty and manipulation into calculated gains. The first step in seizing strategic opportunity is awareness. Awareness of how the kill switch operates, who controls it, and under what conditions it might be activated allows participants to anticipate market movements before they occur. Most investors respond to visible trends in past data, but those who study the patterns behind manipulation can act preemptively. This foresight transforms risk into a manageable variable, allowing for strategic positioning that capitalizes on volatility rather than being harmed by it. The hooks here are simple yet profound. In a system designed to favor the powerful, knowledge becomes power, and anticipation becomes profit. Opportunity also emerges in adaptability. The market rewards those who are flexible, who can pivot strategies in response to changing conditions, and who are not rigidly bound to conventional approaches. Traditional investment methods may falter when price signals are distorted or liquidity is frozen, but creative strategies, such as hedging, diversifying across correlated assets, or leveraging alternative markets, can mitigate risk and maximize potential gains. Those who cling to outdated models may find themselves trapped by the very mechanisms designed to maintain control, while adaptable participants navigate the landscape with agility, turning obstacles into stepping stones. Timing is another critical component. In a market influenced by centralized intervention, the ability to act at the precise moment separates success from failure. Strategic opportunity is rarely about reacting after the fact. It is about positioning oneself ahead of shifts, identifying when the market is likely to move, and executing with confidence. This requires discipline, patience, and a deep understanding of both the mechanics of control and the natural behavior of the market. Investors who cultivate these qualities can exploit brief windows of advantage, capturing value that others overlook or are too hesitant to pursue. Education and insight amplify opportunity. Those who invest time in understanding market structures, historical trends, and the behaviors of dominant players gain a unique perspective that is not available to the casual participant. The kill switch may intimidate many, but for the prepared, It provides signals, clues that reveal patterns of intervention and potential future actions. By reading between the lines and interpreting subtle market movements, informed investors can anticipate outcomes, hedge effectively, and even leverage controlled interventions for strategic benefit. The hooks are compelling. What appears as a threat can actually be a roadmap for those who know how to read it. Finally, strategic opportunity is about mindset. While the market may appear tilted in favor of those who control it, the real advantage lies with those who remain disciplined, vigilant, and proactive. Fear and hesitation are the enemies of profit, but confidence grounded in knowledge transforms uncertainty into opportunity. In a landscape where manipulation exists, those who understand the system, stay informed, and act decisively become not just participants, but leaders shaping outcomes rather than being shaped by them. The ability to see opportunity where others see risk is what separates the successful from the average, the visionary from the passive. The control of critical market mechanisms, like the kill switch, does not merely affect individual investors or traders. It has profound systemic implications that ripple throughout the entire economic framework. When a few powerful players dictate the flow of silver trading, the natural dynamics of supply, demand, and price discovery are disrupted, and the integrity of the market itself comes into question. This is not a localized risk. It is a structural challenge with far-reaching consequences that can affect economies, industries, and financial institutions on a global scale. The hooks are impossible to ignore. When systemic structures are compromised, the repercussions extend beyond money, impacting trust, stability, and the very functioning of markets we depend on every day. Markets exist on the assumption that participants act independently and that prices reflect real economic conditions. When centralized control intervenes, this assumption no longer holds. Price signals become distorted, liquidity becomes conditional, and volatility may be artificially manipulated. This undermines confidence, not just in silver, but across other commodities and financial markets that are interconnected. Investors begin to question whether market movements are the result of genuine economic factors or the orchestrated actions of powerful entities. The ripple effect spreads, influencing capital flows, investment decisions, and even monetary policy, as regulators and institutions struggle to respond to a system where transparency has been compromised. The systemic implications are also visible in the way risk is distributed. In a free market, risk is theoretically spread across countless participants, allowing losses and gains to balance over time. When the market is manipulated, risk becomes concentrated. Those with control can shield themselves, while the broader market bears the consequences. Small and medium investors, and even institutions without direct access to intervention mechanisms, are disproportionately exposed. This concentration of risk can exacerbate financial instability, creating the potential for sudden shocks that ripple through banking systems, supply chains, and broader economic activity. The hooks are stark. Who really bears the cost when the market is no longer free, and who profits from a system that can bend rules at will? Systemic implications also extend to innovation and growth. Markets are not just platforms for trading, they are mechanisms for allocating capital efficiently, for rewarding ingenuity, and for encouraging entrepreneurial risk-taking. When control is concentrated, distorted, or opaque, these mechanisms weaken. Investment flows may shift away from productive ventures into speculative or controlled environments. Entrepreneurs may find it harder to access fair pricing for essential commodities, delaying projects or stifling development. The broader economy suffers, and the promise of free markets as engines of growth and prosperity diminishes. Understanding this dynamic is critical. The health of the market is directly tied to the broader health of economic systems, and when the system is compromised, everyone feels the impact. The hooks for informed participants are clear. Awareness of systemic risk provides a competitive advantage. Those who understand how manipulation affects broader structures can anticipate trends, hedge appropriately, and identify sectors less vulnerable to concentrated control. Knowledge becomes more than a defensive tool. It becomes a lens through which opportunity can be identified. In a landscape where structural control exists, those who study patterns, understand vulnerabilities, and act strategically can position themselves not just to survive, but to gain leverage over markets that others perceive as chaotic or hostile. The systemic implications also demand vigilance and critical thinking. Market participants can no longer rely solely on conventional models or historical precedent. They must adapt to a world where the rules can be shifted. Interventions can occur without warning, and the mechanisms of control are hidden from plain view. By analyzing data, interpreting subtle signals, and questioning apparent anomalies, participants can maintain an edge in an environment where uncertainty and manipulation are pervasive. The ability to see the system as it truly operates, rather than as it appears, separates those who are passive observers from those who actively shape outcomes. And it is in this space that knowledge, insight, and decisiveness become the ultimate currency. So today I urge you, watch, learn, and prepare. Understand the kill switch, the mechanisms of control, and the forces at play. But do not despair, because even in the darkest moments, opportunity shines brightest for those ready to seize it. The free market may be under attack, but your ability to adapt, to innovate, and to protect your future is stronger than any switch. Remember, power favors the prepared. Take control of your knowledge, take control of your decisions, and never, ever let anyone control your destiny for you.